Before we start, we want to make it clear that the information presented in this video is for educational purposes only and should not be taken as a financial advice. Investing in the financial markets involves risk, and it is important to conduct your own research and seek the advice of a qualified financial professional before making any investment decisions. We don't aim to defame any company or portray any company superior over other. The content presented in this video is based on publicly available information and is subject to change without notice. We do not guarantee the accuracy, completeness, or reliability of any information presented in this video. Any investment decision you make are your own, and we are not responsible for any losses or damages that may result from your investment decisions. The content in this video is not a recommendation to buy or sell any securities, and we are not endorsing any specific investment product or services.
Hello everyone. Today we are going to discuss few concepts of valuation and also understand investment ideology of two great Indian investors, that is Mr. Anil Goel and Mr. Shyam Sekhar. So let's begin. Today in total we are going to discuss 6 concepts of valuation, that is discounted cash flow, payback period and price to earnings ratio, decoding free cash flow to the firm, decoding price to earnings ratio re-rating. All these 4 concepts would be explained by Purva Jhaveri, and next 2 concepts, that is high growth company but low value, does high return on equity lead to more value? These 2 concepts would be explained by Darshan Garg. Now, Mr. Shyam Shekhar's investment philosophy would be discussed by all 3 of us, and myself, Priyanshu Agrawal, I will discuss the investment philosophy of Mr. Anil Goel. Now, I request Purva Javeri to begin with the presentation.
So now let's start with the first slide, which is discounted cash flow. So what is discounted cash flow? In equity market, a person is unclear with the target price. But now if a person knows what is the target price, he must know what is the right value that he should pay today, which is called present value of all the future cash flows. So now let's understand through some numbers. So let's assume that, let's see that if there is a business A, this is a business A, which is a steel business, okay? So there is a 5-year cash flow. In the first year, a business is earning 100 crore. In the second year, it is earning 200 crore. In the third year, it is earning 300 crore. In the fourth year, 400, and fifth year, 500 crore. And at the end of the fifth year, we are going to sell this business at 5,000 crores. So now if we sum it up, sum all the future cash flows, we are getting the value 6,500 crores. But is it right that we should pay this business 6,500 crore today? No, because of 2 reasons. First is inflation. Let's say if we buy something today at 300 crore, and after a few years that same thing will be worthy of 500 crore. So now we know that in future business is going to on 6,500 crore. So it is obvious that we will pay less. And the second reason is, we want any investor, not we, just any investor wants inflows to be greater than outflows. Now, as we know that future value is equal to present value into 1 plus I divided by 100 raised to n. This formula we have learned from grade 8. So now let's imply this formula. Now what is future value? The future value is nothing here but the 100 crore, 200 crore, 300, 400, 500, and that's 5,000 crore. Present value is the value which we want, that what should we pay today. 1 plus I divided by 100 raised to n. Your I is nothing but discount rate. Discount rate is equal to opportunity cost and interest rate. What is opportunity cost? Opportunity cost is the next best alternative forgone. So let's see, now let's imply the formula here. In the year 1, if we assume that the discount rate of the steel business is 10%, so 1 plus I divided by 100 raised to n. Now let's see this, how this 1.1 came. So it is nothing but 1 plus 10 by 100 raised to power 1. Now in the second year, we expected return is 1.21. So it is 1 plus 10 divided by 100 raised to 2. And as it goes on till year 5. Now let's see the present value of this 100 crore at the end of the first year. What will be the present value today itself of the cash flow which we are going to earn at the end of first year, which is 100 crore. So this we calculated simply by dividing the cash flow, which is FV 100 crore, divided by expected returns, which is 1.1. Similarly, in the second year, we were able to see the present value as 165 crores. In the third year, it is coming as 225 crores. In the fourth year, it is coming 273 crores, nothing but 400 divided by 1.46. In the fifth year, we'll do 500 plus 5,000 because we are selling that business. So if we are also selling, we also know that what should be the present value of that amount which is being sold. So it is coming out to be 3415 crores. So now, if we sum all these five cash flows, we are going to get the present value, which comes out to be 4170 crores. You can see this. We have summed it up. So now we are able to understand what is the present value of all the future cash flow. Now let's prove that all the risky businesses are more valuable. Now let's say that if we invest in a FMCG business, the return would be less as compared to the steel business, which we took as an example. But you can get the safety of a capital, so the discount rate of FMCG would be less as compared to the steel business. It is very obvious, right? So now, if we assume that the expected return is 6%, so as we calculated 1.1 year in this example, we'll do 1.06 similarly like that. We can see the formula here, 1.06, how it came, 1 plus 6 by 100 raised to 1, 1 plus 6 divided by 100 raised to 2. Similarly, it is going for till the fifth year. Now, the present value as we calculated here, it is similarly calculated here also. It is coming out to be 94 crore in the first year, 170 crore, 77 crore in second year, 251 crores in the third year, 316 crores in the fourth year, and fifth year it is coming out to be 4,109.91 crores. So now if we sum all the present value of future cash flows, we'll get 4,951 crore as the present value of all the future cash flows. Here we can see that as we reduce the discount rate, the present value of future cash flow increased because all the other things were assumed to be same as we took in the steel business example. So thus, less risky businesses are more valuable. There are other things also, but for just basic understanding of this, we'll prove that less risky businesses are more valuable. Now let's prove how high growth businesses are more valuable. Here we have done nothing, but here we have just increased the cash flow. Before in the first year we were earning only 100 crores, but here in our example we are earning 200 crores in the first year, 400 in the second year, 600 in the third year, 900 crore in the fourth year, 1200 crores in the fifth year, and we are selling the business at 5,000 crores. Now we are assuming that the expected returns, like the discount rate, is assuming to be same, 10% only. So it comes out to be 1.1, 1.21 in the second year. We can see it is just similarly we have calculated where in the above example also. So now if we see the present value of the future cash flow, like if we are going to earn 200 crore in the future, now let's see what is the present value. So we have done nothing, but we have just divided 200 divided by 1.1, which comes out to be 181 crores. Similarly, in the second year, we have done 400 divided by 1.1, 1.21, which comes out to be 330 crores. In the third year, it is 600 divided by 1.331, which comes out to be 450 crores. In the fourth year, it comes out to be 614 crores. And the fifth year, we'll add 5,000 plus 1,200, which comes out to be 6,200 divided by 1.61, which comes out to be 3849 crores. So now, if we sum all these numbers now we sum all the present value of all the future cash flows, the value comes out to be 5428 crores. Thus, it proves that high growth businesses are more valuable. Now, let's see the third example. Now, let's prove how the longevity of businesses are more valuable, because as long as the business will run, the more valuable it gets. Now, let's prove it. Now, let's assume that the business is earning same cash flow. In the first year, it is earning 100 crore. Similarly, in the second year, 200. In the third year, it is 300 crores. Fourth year, fourth year, 500 crores in the fifth year, 600 crores in the sixth year. And let's say it is being sold at 5,000 crores. Now we are assuming here the expected returns to be same as 10%. Sorry. So in the first year, it comes out to be 1.1. Similarly, in the second year, 1.211 plus 10 divided by 100 is to 2. 1.331 in the third year, 1.464 in the fourth year, 1.61 in the fifth year, and 1.77 in the sixth year. Now, now let's see the present value of the future cash flows. Now let's divide 100 divided by 1.1, which comes out to be 90.9. Similarly, 165 crores. Similarly, 225 crores in the third year. Similarly, 273 crores in the fourth year. Now, similarly, 310 crores in the fifth year and 3161 crores in the sixth year. Now, if we sum all this future cash flows, so the present value comes out to be 4,226 crores. So thus, now if we compare this with this example, here the years were only 5 years. So we discounted it for 5 years. It comes out to be 4170. But here we discounted it for 6 years as the business is running for a longer period. So it comes out to be 4,226 crores. Thus, this statement is true that the business with longevity are more valuable. So now let's understand what is payback period and P. P is the price which we are paying for the company that is earning 1 rupees. So if the P is 10, so we are paying 10 rupees for the company that is earning 1 rupees. People tend to say that low P stocks are low P is undervalued stock. So now let's prove that statement. But before proving that statement, let's see what Peter Lynch introduced. Peter Lynch taught us about the payback period. Payback period is in how much time the money will get recovered. So now let's understand through the Excel sheet. Let's take time 0. We are standing there and the company is generating 1 rupees EPS. EPS is nothing but PAT of the company divided by number of outstanding share of a company. So if a company has a PAT of 10 crore and there are 10 crore shares in the market, so 10 crore divided by 10 comes out to be 1. So EPS of a company is 1. For now, let's assume that the company grows at 0%. So EPS remains constant. Now let's assume current stock price at which we bought is 3. So the P comes out to be 3 because P is current market price divided by EPS. C10 divided by C5, which comes out to be 3. Now so the P ratio of the company is 3. Now if we buy this stock at the P of 3, in what time frame we will be able to recover our money? If company is earning 1 rupees per share and if the growth is 0%, so the company will earn 1 rupees perpetually, as we can see. So now I have written cumulative EPS here, as you can see. What is cumulative EPS? Cumulative EPS is the amount the company isn't giving any dividend. So the money which is getting accumulated is called cumulative EPS. So at the end of third year, the company has accumulated 3 rupees and we bought it at the P of 3. So we are able to recover our money in 3 years. Now, if the price at which we bought was 10 rupees, so the P comes out to be 10 and the payback period is also 10 years. So and from the 11th year, your profit starts. So hence the world says we should buy low P stocks. So if a company growth is 0%, so the P ratio will be same as payback period. Now, coming to matrix 1. There is a company A, company B, company C, company D, which has a current EPS of 1 rupees, 1 rupees, 1 rupees, and the market price of company A is 100, company B is 100, company C has 20 rupees market share, and company D has market share of 100 rupees. Has market price of 100 rupees. Now, if the P of company A is 100, company B is also 100, company C, if we see, it is 20 times, and company D has P of 100 times. Now the growth rate of company is 20%. We are assuming 20%. Now growth rate of company B is assumed to be 30%. Company C has growth rate of 20%, and company D has growth rate of 80%. Now let's calculate the payback period. we did the similar calculation here. We'll do the same calculation in this company A, company B, company C, company D. Now, but there is only one crux. The company here, this company was growing at 0% growth rate. So the EPS continued to be same. But here, the company A is growing at 20%, which is compounding at 20%. So the cumulative EPS, so the payback period of this company comes out to be 16 years. Now, similarly, the payback period of company B, which is growing at 30%, is coming out to be 12 years. The payback period of company C, which is growing at 20%, comes out to be 8 years. The company D, which is growing at 80%, has the payback period of 6.5 years nearly. But let's compare all the four companies with each other. Now, if we compare business A versus business B versus business D, where all had the same P. If we see all the three companies had same P, but the company D had lesser payback period. So anyone would prefer company D. Now let's compare company A versus company C, which both had same growth rate, but company C had lesser payback period. So one would prefer company C. The real dilemma is between company B versus company C. The company B was growing at 30%, whereas company C was growing at 20%. But still, the company C had lesser payback period. So one would prefer company C with the lesser payback period. Now, if we compare company C versus company D, both the company C was growing at 20% and company D was growing at 80%. We can see that company D had less payback period than company C, but one should prefer company with sustainable growth rate. We don't know if the company D is going to grow 80% for 6.5 or 7 or 8 years, but at least 20% is a sustainable growth rate. So one should prefer company C even though it has little higher payback period. So this is a concept of payback period and P. So now let's understand future free cash flow to the firm. So valuation of a company is nothing but present value of future cash flow to the firm. There are different types of cash flow. First, CFO, which is cash flow from operations. Second, FCF, free cash flow to the firm. FCFF, future free cash flow to the firm. FCFE, free cash flow to equity. And the fifth is owner's earning. The most useful in valuation is free cash flow to the firm. Now, what is free cash flow to the firm? Free means the cash that is left freely in the hands of owners of the company. Owners are the capital providers. Capital providers are those people, debt provider and equity provider. So free cash flow is the amount of cash flow that is available with the debt holder and equity holder after all the expenditure. Expenditure are of two types: operating expenditure and capital expenditure. Operating expenditure includes marketing, transportation, and etc. Capital expenditure, which is also known as capex, includes land, furniture, and building. Now, how to calculate future free cash flow to the firm? There are two formulas for FCFF. One is CFO minus capex, and another one is FCFF is equal to NOPAT minus reinvestment. Now let's derive second formula through the first formula. Now, as we know that FCFF is equal to CFO minus net capex. Now CFO is NOPAT. What is NOPAT now? NOPAT is not net operating profit after tax plus depreciation minus working capital adjustments. And net capex is asset bought minus asset sold. Asset bought also includes maintenance capex and growth capex. Now, maintenance capex, let's assume that maintenance capex is nothing but depreciation which is charged. So, and growth capex. Now, if we put the whole formula together, FCFF is equal to NOPAT plus depreciation minus working capital adjustments minus of maintenance capex plus growth capex minus assets sold. Now, if we calculate it, NOPAT plus depreciation minus working capital adjustment minus depreciation minus growth capex plus assets sold. So NOPAT minus working capital adjustment minus growth capex plus assets sold. Now working capital minus working capital adjustment minus growth capex plus assets sold is nothing but reinvestment. So NOPAT minus reinvestment. Now we can calculate future free cash flow to the firm if we have growth rate of NOPAT and growth rate of reinvestment. So how to forecast NOPAT growth? Now let's see through one example. Now NOPAT growth is ROIC into reinvestment rate. Now what is ROIC? ROIC is NOPAT of a company divided by fixed asset plus working capital. I have mentioned NOPAT many times. So let's see what is NOPAT. NOPAT is the net operating profit of a company after tax. NOPAT is owner's earning. So NOPAT is for debt holders as well as equity holders. So that's why we take NOPAT and fixed asset upon working plus working capital. Now what is reinvestment rate? Reinvestment rate is the amount which one reinvests in the company. Now let's take a dummy example that if there is a balance sheet of a company whose payable days are 10 crore, fixed assets are 50 crores, debtor days are 20 crores, and inventory is 20 crores. Sorry, debtors are 20 crores and inventory is 20 crores. And now on P&L, if the NOPAT is given 20 crores, now the fixed asset plus working capital will be 50 plus 20 plus 20 plus 10, which comes out to be 100. So ROIC is NOPAT divided by fixed asset plus working capital, which comes out to be 20% at the year 0. Now, business decides to give out of this 20 rupees as dividend and remaining 20 rupees to reinvest in the company. So if ROIC remains same and business invest the 10 rupees in capex now, so ROIC is equal to, we are assuming ROIC to be same in the next year. So it comes out to be 20%. We don't know the NOPAT of the next year, but we know fixed asset plus working capital comes out to be 110 as we invested the 10 rupees again in the business. So the NOPAT comes out to be 22. So we can calculate NOPAT growth, which will be equal to 22 of this year minus 20 of last year divided by 20, which is equal to 10%. We can also calculate NOPAT growth rate by ROIC into reinvestment rate. As we know that ROIC is 20% and reinvestment rate will be, as we know that we invested 10 rupees out of 20 rupees of NOPAT earned last year. So 10 upon 20 comes out to be 50%. So 20% into 50% comes out to be 10%. This is how we calculate NOPAT growth. So valuation of a company is equal to present value of all the future cash flow to the firm, which is equal to expected NOPAT minus reinvestment. Now expected NOPAT here is NOPAT growth, and we know that NOPAT growth is equal to ROIC into reinvestment rate. And how to calculate reinvestment rate? As we saw, capital invested back divided by last year's NOPAT. So to increase the valuation of a company, we need to increase first the ROIC. As ROIC will increase, the NOPAT growth will increase. And as the NOPAT growth will keep on increasing, the valuation of a company will get better. Second, reinvest more money. Like if we would have invested 15% in the business, so NOPAT growth would have been higher. Now, third, business should have big opportunity size. The business should not have a small market. It should have a very big market so that it can expand. It should have a competitive advantage among its competitors. Now, as we know that what is P, now let's understand the concept of P re-rating. Here is an example of few companies whose stock price went up due to P re-rating. Now let's understand what is P re-rating through some numerical example. Let's say if you buy a company share at a market price of 1,000 rupees. Now the company has a PAT of 1,000. It has outstanding shares of 25 crores. So what will be the EPS? EPS is nothing but PAT divided by outstanding shares, which comes out to be 40. And what is the P? P will be current market price divided by EPS, which comes out to be 25. Now, this company grows at 25%. So now let's see what will be the market price of that company at the end of 5 years. Now, if it is growing at 25%, so the PAT comes out to be 3052 crores. Outstanding shares will be same 25 crores. The EPS comes out to be 122 crore, and the PE of the company, let's say it is 40 at the end of the 5 years. So the current market price of this company would come out to be 4883 rupees. So 4883 rupees. Now, if you can see how much wealth got created between those 5 years. So the wealth which has got created between those 5 years is 4.88 times. It will be 4,883 divided by 1,000. Now the EPS got multiplied by 3.05 times in those span of 5 years. And the P got re-rated by 1.6 times. And if we can see that wealth is a combination of wealth which has got created, it is a combination of EPS and PE rating. If you multiply PE rating and EPS, you get the amount of wealth created in the times. So you can see that 4.88 times has been derived. So now we can say that if the wealth gets created due to earnings, increase in the earnings as well as increase in the PE. But if the PE would have got derated, even though there was increase in the profits, the wealth would got have increased only by 1.8 times. Whereas in this example, we can see that 4.88 times it got created. Now let's take that this PE got derated to, let's say, 15. Now we can see that wealth got created only by 1.83 times. So now all of us understood that what is PE rating. But while buying a stock, one should know that what is the right P of a stock. So how to calculate the right P of a stock? There are three variables that helps to calculate the right P of a stock. First is ROE, return on equity. Second is reinvestment rate. And the third is discount rate. Now let's see through some numbers how to calculate the right P. Now here in this example, expected return is the discount rate as we understood in the above examples also. The reinvestment rate of this business is 0%. And if the business has no leverage, there is no debt in the business, so the ROC will be equal to ROE and ROIC. Now let's say that we are standing at point 0 where the ROE of the company is 10%, the reinvestment rate is 0%. So at the end of the first year, the company, if the company has a capital of 100, so the ROE comes out to be 10 and the reinvestment rate of the company is 0. So in the second year, what will be the capital? So in the second year, capital will be the beginning capital in the first year plus the reinvestment rate will come out to be second year's capital, which will be equal to, we can see the formula 100 plus 0, which comes out to be 100. Similarly, it goes on and on for all the years. But now we can't get, now we know that the business runs for an infinite period. It is a going concern assumption, but we can't calculate it for longer period of time. So now we should know how to calculate the terminal value of a business. Now terminal value is nothing but FCFF in the 6th year. We know that we are only able to assume for 5 years, but we are not able to assume for ongoing 6 years from the 6 years. So now let's calculate the terminal value. Now how to calculate the FCFF in the 6th year? It is nothing but FCFF in the 5th year. So future cash flow in the 5th year into 1 plus growth rate. Here the growth rate is 0%. So the FCFF in the 6 to infinite years, it comes out to be 10 only. Now, as we know that a terminal value is equal to FCFF in 6th year divided by discounted rate minus growth rate. So here how we got 67 crores as the terminal value. Here you can see the formula. We have done nothing but FCFF in the 6th year divided by discounted rate, which is expected return 15% minus 0%. So we got 67 crores. Now we can calculate the present value of all the future cash flows as we have done in the previous examples. So here the present value of future cash flows has come out to be 10 divided by 1 plus 15% in the first year. Similarly, we have calculated it for second year, which comes out to be 7.56 crores. In the third year, it comes out to be 6.58. In the fourth year, it comes out to be 5.72. In the fifth year, it will come out to be 38.12 as it also includes terminal value. Now, we got the intrinsic value, which is the present value as of a business as 67 crores. So the right PE to buy this business would be 6.7, which is how to calculate the PE here. It is nothing but present value divided by this ROE. Let's assume that this ROE is nothing but EPS. So 67 divided by 10, which comes out to be 6.7. This is the right PE of this company. So now if the company is trading at a PE of 7, it doesn't mean the company is undervalued because it is trading in a single digit PE, but it is actually the company is fairly valued. Now, if we see the price to book value of this company comes out to be 0.67. Now, many of us don't know what is price to book value. Now, let's understand it through numbers. What is price to book value? Now, let's say if a company has assets of 100 crores, it has liability of 50 crores, so the equity comes out to be 50 crores. Now, if a company has 10 crore outstanding shares in the market, so the book value per share is what? Book value per share is equal to nothing but the equity of a company divided by the outstanding shares. So the book value per share came out to be 5 rupees, which is 50 crore divided by 10 crores. Now let's say if we buy this company at the current market price of 3 rupees. So the price to book value comes out to be 0.6 times. It is current market price divided by book value per share. Now, let's say this company has fake assets of 30 crores in its balance sheet. So the assets turns out to be 70 crores, the liability comes out to be 50 crores, and equity comes out to be 20 crores. Now it is same that the shares are 10 crore shares only in the market. So the book value per share came out to be 2 rupees. Current market price is similar 3. But here the price to book value came out to be 1.5 times. Now we can see that we might feel that 0.6 is undervalued stock, but here this is an example of optical illusion. Optical illusion is nothing but you feel that दिखने में this stock is मतलब cheaper, but actual में ये stock सस्ता नहीं है, because it has book value of actual, it is book value of 1.5, but now it is trading at 0.6. So this is the concept of price to book value. And now if we calculate this company's price to book value, it came out to be 0.67. Now, for further more exciting concepts, I would like to call my associate, Darshan Garg.
My colleague Purva has cleared up all the concepts of PE re-rating and how to calculate the right PE of a stock based on the fundamentals of a company. Now, we will see, can a high growth company deserve the low valuations? For this, we need to understand what drives the valuation of a company. So let's move to my Excel sheet and understand this in a much better way. Here, we will understand, is that growth the only metric that derives the right valuation of a business? So the answer is growth is not the only factor. It is one of the factor, but the other factors are return on equity, reinvestment rate, and discount rates, which actually derives the right valuation of a company. In the previous example, we have seen that the business ROE is 10% and the reinvestment rate is 0%. Hence, the growth rate came to be 0%. And the company's intrinsic value, which is the sum total of all the present value of future cash flows, is 67. And the valuation, and the fair valuation is 6 to 7 times. Now, if I increase this growth rate, what will be the effect of this on the valuations? So for this, I have explained this through another example. So I have increased the growth rate by increasing reinvestment rate from 0% to 50% and taking ROE as 10%. Say, to know what is the effect of growth on the valuations. So the growth rate comes to be 5%, which is 10% into 50%, as growth rate is ROIC into or ROE into reinvestment rate. Now, let's assume the initial capital is 100 and the ROE is 10%. That means 10% of 100 is 10, and company is generating 10 rupees, and out of which 50% is reinvested, which is 5 rupee will be reinvested into the business, and the free cash flow in the year end will be 5 rupee. Now, in the year 2, the initial capital would be 100 plus the reinvested amount, which was 5. So it would be 105. And the 10% is 10% of 105 is 10.5, out of which 50% is reinvested into the business, and 5.25 is the free cash flow in the year 2. Now, in the year 3, the initial capital would be 105 plus 5.25, which is the reinvested amount. So the 10% of 110.25 is 11.03, out of which 5.51, which is 50%, will be reinvested again into the business, and 5.51 would be the free cash flow at the year 3. It would be same as of year 4 and 5. In the end of year 5, we have to calculate the terminal value. So the terminal value is calculated as cash flow at the 6th period divided by discount rate minus growth rate. So the cash flow in the year end is 6.38, which would be divided by discount rate, which is 15%, minus the growth rate, which is 5%, which comes to be 63.81. So the free cash flow at the year 5 would be 6.08 plus terminal value, which is 63.81. Hence, the free cash flow at the year 5 would be 70. Now, these are all the cash flows at the year end. Now, we will calculate the present value of all those future value. So, in the year 1, it will be the present value, the cash flow of the year 1 divided by 1 plus discount rate, which is 15% into raised to 1, which is 4.35. Similarly, with the second year, which is 5.25 divided by 1 plus 15% raised to 2. So this is how the present value will be calculated of all the future cash flows. Now, the present value or the intrinsic value is the sum total of all the present value of future cash flows, which comes to be 50, and the fair value, which would be 50 divided by EPS. PE's formula is market price divided by EPS, and the market price comes to be 50 divided by EPS, which is 10. Hence, the fair PE comes to be 5 times. Now, in the previous example, we have seen that the growth rate was 0% and the company's present value was 67, and its fair PE came to be 6.7 times. And now, when I have increased the growth rate to 5%, the present value has come to 50 and the fair PE is 5 times. That means I have increased the growth rate and the valuations have decreased. So the basic reason for this is very simple. So the main reason is that if the ROE is very low and the expected return is higher, which is 15%. So it creates the economic loss. Hence, the valuation comes out to be lower. If a company has low ROE, rather than focusing on growth, the company should focus on increasing ROE by increasing profit margins, asset turnover, and controlling leverage. PET margins can be margins are of four types: gross profit margins, EBITDA, EBIT, and PET margins. And asset turnover has two components, which is fixed asset turnover and working capital turnover. So there are many ways through which ROE can be increased. So the main focus of the business should not be growth, but increasing ROE. Don't get excited by seeing growth. See what returns the business is generating. If ROE is less than the expected returns or opportunity cost of the investor, this company will be worse than a company that is not growing. Now, the next question arises: does high ROE lead to high valuation? So, I will explain it further. Here, we are going to understand the concept of ROE on valuation. For this, I would like to open my workings. Here, we are going to understand how increase in ROE is actually affecting the valuation of the business. Does increase in ROE will increase valuation? So, to understand this, in the previous example, we have taken ROE as 10%. So now I am taking ROE as 12.5% and growth rate as 0% to understand the impact of increase in ROE on the valuation. So for that, I have taken investment rate to be 0%. Now, the initial capital in the year 1 is 100 and the ROE is 12.5%. So the business is going to generate 12.5 rupees. And since the reinvestment rate is 0%, so the cash flow would be free cash flow would be 12.5 rupees. Same goes with the second year. 100 would be the initial capital. The company would generate 12.5 and again the reinvestment would be 0 and hence the dividend and the free cash flow would be 12.5. Same goes with the year 3, 4 and 5. Now at the end of the year 5 we are going to calculate the terminal value. Terminal value is the cash flow of 6th year divided by discount rate, which is 15%, minus growth rate, which is 0%. So the terminal value comes out to be 83. So the free cash flow of year 5 would be 12.5 adding with terminal value of 83, which will comes out to be 96. Now, these are all the future cash flows. These are to be discounted to the present value. So for this, in the year 1, the present value is 10.87 as the 12.5 divided by 1 plus discount rate, which is 15% raised to 1. And for the second year, which would be 12.5 divided by 1 plus 15% raised to 2. So these are all the present value of all future cash flows. So the intrinsic value is the sum total of all the present value of all future cash flows, which comes out to be 83. P comes out to be 6.7, which is 83 divided by 12.5. Now, if you observe it, you can see that when the ROE was 10%, the intrinsic value was 67. And now when the ROE increased to 12.5%, the intrinsic value also increased, which is it came to 83. That means the increase in ROE has increased intrinsic value. And before, the PE was 6.7. And now also the PE is 6.7, which means the valuation has not affected due to the increase in ROE. This is a fascinating thing about valuation. Increased in ROE hasn't impacted the valuation of the business. The valuation remained same as the intrinsic value increased with the increase in the earning per share, because before the company was earning 10 rupees as the ROE was 10%, and now the company is earning 12.5%, 12.5 rupees as the ROE is 12.5%. So the PE remain the same. So now comparing price to book value, before the price to book value was 0.67 when the ROE was 10%. And now the price to book value is 0.83 when the ROE has increased to 12.5%. This means the increase in ROE has increased the price to book value. This comes to the conclusion that increase in ROE impacts price to book value, but doesn't impact valuation of the business. That is, there is no change in PE, but price to book value increases when increase in ROE. Now, in the below table, we can observe that the ROIC or ROE is increasing and the PE has remained same, which is 6.7. But the price to book value has been increasing when the increase in ROE. So here, when the ROE was 14%, the business price to book value was around 1. When the price to book value is equals to 1, which means that the company is generating the same return as expected returns, which means the ROE is equal to the expected returns. So in the case, so here our expected return is 15%. Hence in the 14%, the ROE came 0.93. Now, when there is when the ROE or ROIC is greater than the expected return, the business gets higher valuation as the price to book value increases. Like when it was 17%, it is 1.13, and now when the ROE is 30%, the price to book value is 2, which means when the ROIC is increasing, the price to book value will increase, and hence there is no impact of price to earning ratio. Here I have show you the change in the price to book value, and this is a change in the value of it is the intrinsic value, which will become at the ROE when it would be 12%. So it is also 19%, and this is also 19%, which means that the change in the value or change in the price of a share is because of the change in the price to book value, which is because of the ROE change. Hence, we are now have completed the concept of valuation. Now, I would like to call my associate Purva to, to introduce about one of the greatest investor, Shyam Sekhar.
Now, let's start with our first investor, Mr. Shyam Sekhar. Mr. Shyam Sekhar has more than 3 decades of investing experience in franchisee based, high growth businesses. He follows a value based approach to investing. Now, what is value based approach to investing? My associate Darshan Garg will explain you. His focus is on identifying investment opportunities in emerging companies through a sound research driven process. Mr. Shyam Sekhar is the founder of iThought PMS, which is a PMS plus mutual fund house. Here are the mutual fund performances of the iThought PMS of last 5 years. Now let's talk about his early life. Mr. Shyam Sekhar was born in Chennai in 1968. He completed his chemical engineering at Annamala University in Chennai. He had later on joined his father's business in 1990. It was an industrial paint business. Now let's see his learning from running a business. He saw some challenges faced in the business. He acquired the management skills he needed to evaluate a business. He was good at managing the working capital, which has helped immensely in the investment journey. He also understood the tech system and how to interact with the customers. Now let's see his journey in investing in the stock market. He started investing in 1990. He did his own equity research to start investing. Now later on, he went to his neighbor, Mr. K. Sudarshan, who was his idol, who made him start doing investment. He read an annual report at Mr. K. Sudarshan house. Then his neighbor taught him how to read the annual reports as he was curious to know. Now, he doesn't communicate with the stockbrokers. He was like an outsider in the investment world. And not to communicate with the stockbrokers and not taking tips from other people has immensely helped him in his investing journey. He had a small circle of people and used to discuss companies with them. He used to follow a scuttlebutt approach. Now, what is scuttlebutt approach? Scuttlebutt approach means talking with the network of businesses like distributors, wholesalers, customers to understand the management of the business. He had set Franklin Templeton, which was previously known as the best mutual fund house, as his benchmark, so that he can become the better investor. Now let's see Shyam Sir's initial investment philosophy, like how he used to invest. He used to invest in those businesses like what he understood well. Buy companies that had good management, solid franchisee, low debt, and exceptional capital allocation. His approach was completely oriented to Fisher style. Now, what is Fisher style? My associate Darshan Garg will explain you in the video. What is franchisee investing? Investing in companies whose future cash flow can be predicted. Like we can predict futures cash flow of HDFC Bank, Coca-Cola, Pidilite. Those are the established business, so we can predict their future cash flows. So he invests in franchisee-based investing. Now, what were his first major success? His first major success was HUL, which he studied in 1990. But he did one mistake. He bought 60% of his portfolio. He bought completely 60% of the portfolio and invested all the money in HUL, which was not good. But by luckily, in 1990, he made three baggers and the valuation of that business became very high. His second purchase was ITC. ITC, he bought it before the Calcutta Stock Exchange broker took it to the new high. He bought a very large position before the 1992 boom. What was before 1992 boom? 1992 boom was Harshad Mehta stock price manipulation boom. Now, for the further explanation about his big successes, his failures, I would like to call my associate Darshan Garg.
Let's talk about his big successful investments. His first big successful investment was in Hudson Agro. It was a Chennai-based company that was building a brand in ice creams. It was building a new category of liquid milk. So he saw that it is a great opportunity in that category for the business, and also Amul was doing the same thing. So expanding into a new segment is not bad. The main thing is that the business should grow its category, which will really going to grow in the future. Then he has gone deep into the business and analyzed its financials. It was a negative working capital business, which means the business is cash flow efficient and the company will require no or less debt to expand. The business was allocating its capital efficiently, which is very important while expanding the business and generating more returns in the future. Now, let me show you the numbers of the business. The revenue and PAT grown over the years. The PE was 116 times in 2018. In 2005, the PE of the business was trading at 60 times, which means it was expensive. But he still invested and has trust in his process. He understood that liquid milk as a new category will grow and the business will expand. The next investment is sanitary ware. The business is into sanitary ware, faucetware, ceramic tiles, and others. It was a small company. He started studying Sarah when the market cap was 100 crore. It already grew from 30 crore to 100 crore market cap. It was a high margin business and was generating good cash flows. The business has a low debt with high ROE, and ROE has increased over the years. Also, the valuation of the business was cheap. So he started buying a small position in Sarah and kept increasing his position. A good investment has two aspects. First, finding a good business. It was a good management business with high margins and generating cash from the business. Secondly, the right valuation. So the valuation at which he bought Sarah was very cheap. So it turned out to be a good investment for him. Now, let me show you the numbers of the business. We can clearly see that PAT was growing over the years. In 2008, Sarah was trading at PE of 7 times, which was very cheap. Also, the ROE of the business has kept growing. Now, the next part is balance sheet versus P&L. Balance sheet consists of assets and liabilities, and P&L consists of revenue, profits, and expenses. The growth in P&L comes from the balance sheet. This is because the business first purchases assets that are added to the assets in the balance sheet first, and then it generates revenue which affects P&L later. So a strong balance sheet will lead to a strong profit and loss statement. So while analyzing a company, it is important to look at how strong the balance sheet of a business is. Benjamin Graham, father of value investing, mainly focuses on 80% P&L, that is profit and loss statement, and 20% balance sheet. When you are buying business based on a strong profit and loss statement, you have to buy at a high valuation. This is because the investors have already bought the stock before seeing the strong balance sheet. So investing based on balance sheet keeps you in advantage. You have a margin of safety, but you have to wait to get reflected in the P&L. The next part is Ramin versus Fisher style of investing. Graham investing. is based on value investing. It means buying stocks that are trading at a price below intrinsic value or undervalued stock. Value, value investors look for stocks that have a margin of safety, meaning that the market price is significantly lower than the calculated intrinsic value. Value investing is associated with a long term investment horizon. It requires patience and discipline. Fisher's approach is referred to as growth investing. It means identifying and investing in companies that have the potential for above average growth in their earnings, revenues, and market value. So it looks beyond the current financial performance of a company and focuses on future prospects. Both are good ways of investing. The next part is the process of value addition in a business value chain and the valuation it should get. Businesses that add value to the product level may trade at higher valuation. This is because these businesses have pricing power. They have their brand value and their realization increases because the business is able to charge higher to the customers. And on the other hand, commodity businesses pricing totally depends on the stakeholders. It depends on the raw material prices, business cycle, and other factors. Now, let us talk more about his successful investments. His first successful investment was Amra Raja Battery. It was in the business of industrial batteries. The company started spending money to grow a new segment of auto batteries. He read the annual report and found that the company would complete its annual amortization expense of rupees 10 crore, the very 10 crore. This means that the earnings would jump by 10 crore the very next year. Here, I have explained it through dummy numbers. Let's assume that the amortization expense of the business is 500 crore from year 1 to year 5, and the company is now going to complete its annual amortization expense of 500 crore in year 6. So in year 6, the amortization expense will become 0 and the PAT will increase by 500 crore in year 6. Now, he sells his holdings because of the losses in the short trades he made in the market in 2007. He hasn't focused on portfolio construction and position sizing, which are very important factors to reduce our risk of losing capital. Now, let me show you the numbers of the business. The company's revenue grew from 164 crore in 2002 to 6059 crore in 2018. In 2002, the valuation of the business was very cheap. It was trading at 5 times PE. It was a good opportunity to buy that business. The company's ROE also increased from 11% in 2002 to 17% in 2018. This this shows the business was going to expand into the auto batteries and the market was huge in that segment. Hence, the ROE increased over the years. The next investment is La Opala. The business is into manufacturing of glassware, which includes plates, bowls, dinner sets, cup sets, etc. It was a high margin business and he expected that the business would generate free cash flows. It has immense growth potential. It was trading at a cheap valuation based on price to cash flow. Also, the main turnaround for the business is the change in the trend. Before, people used to eat on silver plates and use silver glasses. But now the trend was changing. It was used only when there are special guests coming. Otherwise, everyone was using ceramic plates or stainless steel plates. This shows how change in a trend changes a business. Identifying trends and investing based on this generates a good investment idea. He sold the stock when it became overvalued. Now, coming to the numbers of the business, the revenue went from 75 crore in 2010 to 235 crore in 2017. Also, the PAT grew from 3 crore to 62 crore in 2017. This shows that the business was a good business and the valuation was also not expensive. It was trading at 14 times PE. So it turned out to be a good investment. The next investment is Giant Agro Organics Limited. He actually worked with castor oil, so he understands the business of castor oil. Giant Agro was into the business of castor oil procurement process. It was the world's largest company in this industry. The management of the business was good. The business started with small equity capital, and never raised equity again. It was a family business. Also, nobody was interested in commodity businesses, as it is a price volatility business and is a cyclical business. It is a highly capital intensive business. So people see the risk of huge funds if the company do the wrong investments in acquiring assets. He started buying the shares of the company when the market cap was rupees 75 crore. Overall, it was a good company. He bought 3.5 to 4% of the business. Initially, he hasn't generated returns in the initial period of 3 to 4 years. So sometime you have to wait in to earn good returns. For this, you should have a strong conviction in the business. Now, coming to the numbers, the revenue grew from 904 crore in 2010 to 2551 crore in 2018. The ROE of the business was 14% in 2010, which grew to 19% in 2018. It means the company was generating good returns. Also, the market cap has grown by 8 times. It was a good business and also a good investment. Now, I would like to call my associate Priyanshu to explain about working capital cycle, his big mistakes, and the research process he followed.
Let us see how analyzing working capital helps in understanding in which direction the business is proceeding and also understanding the longevity of the business. He uses the example of a confectionery company which never sold goods on credit and it started giving credit in the month of March. On digging deeper, he got to know that the business was fudging its revenue by showing fake sales. And later, it would term credit sales as bad debt as the money was not coming back to the business. This was done to show that the revenue growth in the year ending was greater than last year. Another example he uses of is of Sri Kalahasti pipes. This business was coming out of pain. The pain point for the business was rupee depreciation. Now, because of rupee depreciation, the imports were more expensive and it has to pay now more rupees for a dollar. Another reason was high raw material cost. Now, due to high raw material cost, the cost of goods sold of the business will be higher and the gross profit would be lower. Also, due to some hedging activities, the business faced some derivative losses. All of these were balance sheet items, but it was depressing the profit and loss statement of the company. Now, in order to check whether the balance sheet would be healthy again or not, he checks whether the business is able to convert cash from its business operations or not. In the case of Sri Kalahasti Pipes, it was able to generate some cash from its operations. So our first checkpoint got ticked. Also, on digging deeper, the company was cleaning their old mistakes and raw material prices were easing. So this was another checkpoint which got ticked. Also, the company was available at such a low valuation, he decided to invest money in this company. Now, let us see the reasons behind actual losses or opportunity losses faced by Mr. Shyam Sekhar. First is selling a stock early before it has attained its full potential. Like Mr. Shyam Sekhar was the earliest buyer of Shree Cements, but they sold off early as they thought that the stock was expensive and has reached its full potential, and the management perception was not that good. But then also the stock performed well. The second reason is unwillingness to hold stocks at high PE. These businesses have a high return on capital employed, and once we sell, the opportunity never comes back to buy these stocks again. The third reason is not buying enough quantity for a quality company is also an opportunity loss, as high returns would have been generated if more number of stocks would have been bought. The fourth reason is he was a great believer in the Royal Enfield story, but he missed out on the opportunity to buy Eicher Motors. Now let us see why he didn't buy expensive stock, but he kept his holdings at high valuations. He was not interested in just buying low PE stocks and selling it at high PE. Following a low PE model won't always make money for him. You always have to pay the price for a valuable company that is going to grow more in the near future. The main thing that is to be judged is growth of the company. If a business is going to grow in the future and is expensive, you should pay the price for it. Like he holds Serra Sanitary Ware at a earnings per share of 100 and PE of 30, as he believes that the company is going to grow by 20% for 5 years from the current scenario. So he waits for a good opportunity to play out. Now let us see his research process. One should read industry opinions, company news, industry analysis, corporate announcements, con call transcripts, business history, magazines, and articles in order to gain market information. One should also identify the trending theme in the market. By this, we can also see the government policies that are affecting these themes. Finding companies that have higher growth in future will also have a massive opportunity because of this change in trend and government policies. Like in the case of Laopala, the trend was changing from steel cutlery to ceramic or glass cutlery. And because of anti-dumping policy, the stock performed well. We should also talk with our investment group and understand what are their views and based on that make our own decision. One is bound to commit mistakes in the market. Main thing is to learn from that mistakes and try not to repeat it again. Now let us see his portfolio structure in terms of number of stocks and percentage allocation. He previously used to invest 100% capital in 6 to 8 stocks. Now, his core portfolio, that is 70% of capital, is invested in 7 to 10 stocks and 30% in 15 to 20 stocks, which he keeps on dabbling time to time. He does not invest in a He does not invest a lump sum amount in a stock. He keeps growing his position from time to time. This helps him to manage risk. His highest exposure in a stock is 10%, and this 10% he gradually increases, like in the case of Serra Sanitary Ware and KRVL. He typically starts with a 2% position. He rarely does bulk buyings. A bulk buying is a transaction in which a large quantity of shares is bought. Now, how to play cycles according to him. He likes to work on a theme before it is about to hit the trough, and during this phase, the valuation looks inexpensive. So he patiently assesses and understands the market conditions, and the intensity to track the theme rises with more fall in the valuation. Once all the risks are completely weighed, he's ready to invest around the trough. Next is purchases are bought on asset valuations or replacement basis. So here we understand the concept of replacement cost of assets and enterprise value. Here the formula of enterprise value is market cap plus debt minus cash and marketable securities. Market cap is the value to acquire equity ownership of the company, while enterprise value is the net value to acquire overall ownership of the company. We have taken your assumption of a sugar industry which is cyclical in nature and it is down by 50%. Here, a sugar company that is Balrampur Chini has a fixed assets of 10,000 crore and a production capacity of 35,000 in liter. Another company in the same industry has recently done capex of 2000 crores for a production capacity of 3000 liter. The name of the company is Renuka Sugars. Here the assumption is that the Balrampur assets of Balrampur Chini are not old and the technology is same as that of Renuka Sugars. Now, to compute the replacement cost of Balrampur Chini, we do cross multiplication and the real value of the assets come out to be 23,333 crores. So if Balrampur Chini goes bankrupt and its assets are sold off, the minimum value we will get that is 23,333 crores. Now, the assumption is that if the enterprise value is equal to or less than replacement cost of assets, we say that the market is giving the company a bankruptcy valuation, which is immensely low valuation. And if in the industry it is seen that the top three or four companies and one of the top three or four companies is caught in this situation, we should invest money in such companies, as with time the valuation would grow and it will generate returns for the investors. uh, and as this is the point of trough for the company and also for the sectors, so with the help of valuation we can find out what is the point of trough for the industry and not with the help of financials. Third point is stick with the top industry players and don't worry much about the upside when there is a huge margin of safety. Fourth is being too early into cyclical turnaround is not easy. You should have a strong conviction and patience for a longer period. It helps in making huge profits. How sector works in cycle through a dummy example. Here we can see that companies' financial statements have been presented over a period of 10 years. In the initial phase, we can see that supply is less in the market. Therefore, in order to increase the supply, the company is doing a capex, that is capital expenditure. So its gross block is gradually increasing, and corresponding to that, its depreciation expense is also increasing on the income statement. Now, these assets are being financed through debt. Therefore, the debt obligations of the company is also being rising, and so will be their interest payment expenses for the company. Now, as the supply is increasing in the market, the revenue of the company is also shooting up, and it has come to a maximum point here we can see that it is generating a revenue of 30,000 in 2007, where the supply in the market is maximum, and so it is generating a maximum PAT of 6678 crores. And here there we can see that from 2007 to 2008 there is a transition phase where the supply is excess in the market, and we can see that there is a gradual dip in the revenue, but its gross block is remaining same, which states that the depreciation expense will also be same, and so is the debt obligations for the companies. Therefore, due to decrease in the revenue but all other expenses remaining same, the company is facing huge losses, and because of that, there is a negative impact on their income statement. The key learnings from Mr. Shyam Sekhar is he strongly believes in balance sheet based growth. He first checks the strength of the balance sheet and how strong their working capital is. He follows both Fisher and Graham style of investing. Accounting has to be strong to understand the business position and the potential it has. He has a strong edge on how to run a business, which helped him to build an investing idea. Investment thesis is he buys solid management companies and franchises with low debt, a good dividend payout company, and a good capital allocation. He focuses on theme based investing and understands the trend and generates the investment idea. Big mistakes that he committed is not holding high PE stocks, selling early, and buying small quantities of good companies. He don't rush to get rich quickly. He says compounding is about time and not capital allocation. All you need is to be a good investor, strong investment behavior, focus, discipline, and knowledge. Now let's talk about our second investor, Mr. Anil Goel. He was born in Batla near Amritsar, where his father was having a metal casting factory. During his college days, he went to Chennai to help his grandfather run their family business of steel trading. Around 1990, their auditor suggested them to start investing in IPO in order to get tax exemption. This was his first investment in equity markets. During that period, stock market was a trending subject of discussion. When the share prices were increasing, he predicted that the market would crash. Since then, he developed an interest in the market. He started with a sum of rupees 50 lakhs, and the value of his investment came down to rupees 33 lakhs. Now he had the eagerness to cover his losses and become a successful investor in the market. Therefore, in May 1993, during the bearish phase, he invested more rupees 5 crore in NBFC businesses as they were doing well due to change in some regulation by the government. And within a year, his investment was 20 crores. These are his current portfolio holdings, and the source for this data is Money Control Pro. Now, let us talk about his investment philosophy. His investment philosophy was around five words: knowledge, conviction, patience, luck, and timely deployment. He says that one should have a deep knowledge of a particular industry or the business he is watching out for. How he conducts his research, we will see in the next slide. After acquiring knowledge, one develops a conviction that is, yes, they are right about the business and its future prospects is great. Therefore, believe in their assessment about the business. After believing in the business model, one needs to be patient for the market to properly value their stock. and one needs to be lucky as process is correct, but the price of the share should drop and match their expected price. When this happens, you should have the nerve to click the buy button. This is the investment philosophy called KCPL-TD. Now let us see his research process. Step 1 is if he likes a company, he would add to his portfolio with a minimal total amount. He believes that by investing a little amount in companies, we would able to track it with more diligence and discipline. Step 2 is he carries out meeting with industry people and discusses about the company. Step 3 is he asks his network, that is his students to whom he has given training, to do a detailed research on that company. Step 4. After having a detailed understanding of business, he meets the management and tries to understand their mindset, vision, and interest in growing business. Step 5. If his vision and potential of the business matches with that of management, he increases his holding in the business. His key learnings from the chapter are: he does not invest in overvalued stocks. He follows an approach when the prices of a stock crashes. Therefore, the valuation would be much lower now. So he analyzes the business. If it is stable or growth is seen in future, he buys it. He followed this with a company named IBRCL. The price fell from rupees 100 to rupees 30, and Morgan Stanley was aggressively selling the share. Still, he started buying in small quantities as he saw stability in this business. Money will be made when good business is bought at cheap valuation. Buying great businesses at abnormal or expensive valuation will not generate return. For example, Hindustan Unilever is a great business, but from 2000 to 2011, it generated 0% return. He bought Relaxo footwear for rupees 3 when nobody was willing to buy it. He bought a good business at a cheap valuation. Look out for good businesses in the industry that are going to grow at a good rate in the future. We should analyze the top 3-4 companies of a commodity sector when it has created a trough. Now, how to find out trough is created when the cost of production is greater than the commodity price. For example, per ton cost of steel is suppose rupees $500, but the current market price of it is rupees $450. Then the demand is less in the market. That is why the industry is at trough. We should invest our money in the top companies of commodity sector when some recovery is seen in the sector. When growth in top line, that is revenue, is witnessed, the bottom line, that is profit after tax, should also grow, like in the case of KRBL. Therefore, to them loan on low interest rate was provided. While LT Foods could not see growth in bottom line with growth in top line. Therefore, their cost of borrowing was high. He mostly invests in small cap or out of favor companies or industries. By doing this, one can be bought at low PE. And he looks out for businesses that have growth potential, good management, and also sharing dividends with shareholders. Investing in such companies can help make a lot of money. He follows deletion is a process of selection method. This means that don't take interest in every sector. Select a particular sector in which you like to invest. Select a few companies from that sector and analyze their numbers quarterly. Also, the core portfolio should have 15 to 20 stocks and rest should be tracking positions. And when the core portfolio matures to full valuation, then tracking position should take their place. Here we conclude this video. I hope it was very insightful where we discussed few concepts of valuation and investing ideology of two great investors of Indian equity markets. The link of the PPT is shared in the description box and also in the comment section. Thank you.